you can try more than just buying low PE stocks, you can do incredibly well. And so the answer is why I'm not worried.
You shameless cloner. Want to track portfolios of famous value investors like Warren Buffett? See their buys and sells, current and historical holdings? Just visit valueinvesting.guru. It is valueinvesting.guru. Link in the description.
You're saying, why does this work? I guess, but my question is almost more, why does this continue to work? In other words, I understand why low PE investing inherently works. I'm more wondering why, since what you're saying is sort of the natural order of things, where there's reversion to the mean, and you know, things that are doing badly get better, and things that are doing well don't stay as well, and they sort of collapse. And if you buy this cheap, it'll get better, usually. I understand that's why it works. I'm not understanding why everyone doesn't do it, because they know this.
I mean, it's like a hog movement, right? Markets are efficient in the sense that inefficient. Big institutions can't mostly pursue that.
Well, I think that's right. I think that's part of that. What Haugen wrote was, if you're a big institution, this is, you know, Buffett said, I'd rather have, you know, a bumpy 15% than a straight 12, okay? And some people would rather have the straight 12 or a straight 10 than a bumpy 15. And here, these are kind of bumpy returns. Yes, over the full period, Decile 1 did do 15%, but there are huge periods, as we saw the cycle of value investing, where there could be 3-4 year periods, sometimes longer, where it doesn't work. And then you say, oh, things have changed, people are doing it, whatever it might be. So it's not just this always works. If it worked every year, it wouldn't work. It works most of the time, you know, over long periods of time. So I think that's one good answer, that from an institutional standpoint, you can't live through the downturn. So it's a very hard strategy to follow. Still, you might be perplexed as to why, because it continues to work everywhere, why more people don't do it. Yeah. You know, I mean, I think we're going back to the question of why I'm not really worried. I mean, that's what I'm trying to get back to. You know, why am I not worried that if I tell you all this stuff, you know, there'll be no more opportunities? I think on the margin, most stocks aren't priced based on someone doing a quantitative low PE model, even though some people are. I think they're priced because someone says, this is terrible, I got to sell my stock. And that's, you know, or next year or two is going to be bad, I don't want to own this in my portfolio because I'm an institutional manager and I got to pick stuff that I think is going to do well because I'll be out of a job in 2 years if by the time this thing turns around, or before the market. So I know it's cheap, but I still got to sell it. Or if I'm an analyst at a firm, which I really can't understand the logic, but it's more like they're not going to do well next quarter, so therefore the stock is no good. They make that connection, which, you know, the stock is not something I want to own, which there should be not that much correlation. You know, it takes price out of the analysis, but that's where a lot of bargains come. And, you know, if you were here a few years ago, I used to come in and bring in the analyst reports of, you know, I know this is only at 6 times earnings, but next quarter is really going to stink, okay? And that's the analysis, you know? And so we're going to buy it when things get better. And there's many of those. So I don't know if I answered your question as to exactly why, you know, I'm not worried that I'm teaching this stuff. I think there's A, plenty for everyone, and B, this kind of stuff's been going on for years and years. Everyone knows it. It's hard to do. It's hard to do. It's hard to have that outlook. It's hard to live through the tough times. The 2 examples I give in my book are, I don't mention it by name, but there's a book that I recommended to you guys, What Works on Wall Street. And in that book, the guy goes back 40 years, uses CompuStats data to go test, you know, 30 or 40 different strategies, and comes up with the 1 or 2 that are the best of all the strategies over 40 years. And what he did when he wrote this book in about, I think it was 96 or 97 originally, he started a mutual fund. Yes?
You wrote about
Good. So that's good to know. But let me, with regard to the story, I thought the book was very good. I recommended it to you. He did very good analysis. It was very interesting to see what works and what doesn't over long periods of time. So the guy who wrote the book, he ends up setting up a mutual fund to take the best strategy that he had over the 40 years and start a mutual fund. And so what happens? Well, the first year he doesn't do too well. The second year he underperforms the market by 25%. The third year he doesn't compete well with funds of similar, again, he doesn't compete well with similar funds. And so what he does is he sells his management company to somebody else. And what happens after that? So it's 3 years, it hasn't worked out. Okay, the thing that's done so well for 40 years, it hasn't worked out. Now he wants to do some other venture, so he sells his business. But this is the guy who did all the tests. This is the guy who wrote the book. Okay, he sells out. So what happens? The guy who buys the company continues the same exact formula. Over the next 3 or 4 years, it's one of the top performing funds, which makes it, he does so well during those 3 or 4 years that even including in the bad first 3 years, the guy is blowing the doors off of every other fund, has about $2 billion in this fund, yet the guy who wrote the book, who did all the tests, he couldn't hang in there, okay? He had other things to do. I didn't even mention his name in the book because I thought he wrote a good book and I didn't want to, but he's the guy who did the work and he didn't make it. I mean, he sold out before it could turn around. And that's what happens to investors. I also tell the story of, actually not by name, but you met him, Rich Pizzina. And the first 4 years in business, he didn't do well. It was the late 90s. Value was out. He was underperforming the market by huge amounts, doing exactly the kind of work he was doing here, buying stocks that were cheap, the market didn't care about, that were earning a lot of money, that were in good businesses, all these great things. And he underperformed. And, we had a discussion, and, he was going to keep doing what he was doing because he thought what he was doing was right, and I agreed with him. The only people who didn't agree with him were his clients. And so they basically pulled out most of his money during those 4 years. And the rest of the story. He continued doing what he was doing. He way outperformed everyone, has now, probably beaten, he's running $15 billion, outperformed the market since inception, including the bad years, by 700 basis points a year. On huge amounts of capital, which is hard to do. One of the top, 1% of funds. And that's what happened to him when he was doing bad, but almost went out of business. And now there are, out of hundreds of investors, there's 4 people who remain, who stayed for the whole time. And I wrote up on one of them because I said I had to stay because I was his friend. But basically, people don't hang in there. So to explain why this is really tough to do and why it keeps working, I think that's the good news. It's hard to do. It's hard to stick it out. And while it seems like the statistics I have much better statistics in the book, and I'll explain, just trying, how trying does. You can try more than just buying low PE stocks. You can do incredibly well. And so the answer is why I'm not worried. Or, when you can buy a reasonable bargain, it might not be a time that's easy for people to buy, or people might not value the quality of the business. In Buffett's case, a lot of times people won't value the quality of the business, or understand the quality of business as well as he does, the long-term prospects, even especially if there's a short-term blip.
You shameless cloner. Want to track portfolios of famous value investors like Warren Buffett? See their buys and sells, current and historical holdings? Just visit valueinvesting.guru. It is valueinvesting.guru. Link in the description.